Hi, I'm Kelsey Cobb, and today I'll be discussing the topic of credit unions versus banks. Before I really get into it, I wanted to give you guys a brief introduction. Credit unions and banks are both financial institutions that offer the same services, such as savings accounts, checkings accounts, personal loans, and much more. According to dictionary.com, a bank is defined as an institution for receiving, lending, exchanging, and safeguarding money, and in some cases issuing notes and transacting other financial businesses. The credit union is then defined as a nonprofit making cooperative whose members can borrow from pooled deposits at low interest rates. A cooperative means that credit unions are owned and operated by their members, unlike banks who are owned by stockholders. So banks and credit unions seem like they're basically the same thing, but there are two very distinct differences that I'm going to discuss. According to Dave Goldstein, the first difference that I will be discussing is kind of the basic foundation for all the other differences. So the first difference is that credit unions are a nonprofit institution, and their goal is to focus on helping members save their money, borrow, and receive financial services at an affordable cost. A bank, on the other hand, is a for-profit institution, and their main focus is to generate a profit, so all of their core foundations are going to be surrounded by making a profit. The next difference I'm going to talk about is credit unions are member focused. So like I said, they're owned and operated by their members. Credit unions, according to creditunion.gov, there are 98 million people across the United States that use a credit union. You can be a member of a credit union based on where you work, where you worship, and by any group that you might be associated with. Credit unions provide personal service designed to help members grow their savings, pay off debt, and plan for their future. Also, many credit unions provide free financial literacy resources, training, counseling to help members have a better understanding for their financial matters. So next I'm going to discuss advantages and disadvantages to credit unions. First advantage is they're member focused. The next is they are more flexible. So for example, if someone has a rocky credit history or employment history, they are more likely to get approved for a loan by a credit union rather than a bank, due to the fact that banks receive thousands of applications a month, and if you don't meet some of the bank's requirements like income, credit scores, or deposits, a bank isn't even going to consider your application. Next is credit unions offer higher interest rates, and sometimes these rates can be 4 to 10 times higher than local banks. Credit unions are also democratically ran, and this means that each member has a vote in electing the executives of the credit union. Finally, credit unions also offer fewer and lower fees. Some of the disadvantages are credit unions have fewer financial products than banks. So for example, Bank of America offers 5 different types of checkings and savings accounts, 29 different credit cards, and multiple loans and investment products. And on the other hand, a local credit union might only offer 2 different types of checking and savings accounts, 2 different kinds of credit cards, and only a few loans and investment products. And the final disadvantage is that lack of location. So since credit unions are mainly local, they only offer a few locations to their members, unlike a bank who is across the nation. So next, I just have a diagram showing you what credit unions have, what banks have, and then what they both have. And a few things that I would like to point out on this is they are both insured up to $250,000, but a credit union is insured by the National Credit Union Share Insurance Fund, while a bank is insured by the Federal Deposit Insurance Corporation. The next thing I would like to point out is that in a credit union, earnings go back to the members, but in banks, earnings go to outside bonds and stockholders in the form of dividends. Some things that they both have is they are both chartered by the federal and state government. Deposits can also be available on demand in a checkings account or with restrictions on a savings account. And in conclusion, banks and credit unions are both financial institutions, that offer the same services but are just ran differently. Each of them have a different goal in mind. In the large scheme of things, a bank wants to make a profit, and a credit union wants to offer their members the most financial products. And these are my references.